Picture this. You're 22. Maybe you just got your first real job. You're sitting in your apartment, probably a smaller one than you imagined when you were 17, and you're finally making decent money. And somebody, maybe a coworker, maybe your dad, maybe some video on your phone at 11 p.m., says, you should start investing. And you think, okay, yeah, I'll get to that. When things settle down a little, when I pay off this credit card, when I figure out what I'm actually doing with my life. And then you don't. And then you're 27. And then you're 30. And somewhere deep in the back of your mind, there's this quiet voice that says, did I already miss something? Did the window close when I wasn't looking? I want to talk about that feeling today. Not to scare you, not to make you feel behind, but because the truth about starting young and what really happens when you don't is so much more interesting and honestly more human than any chart or calculator will ever show you. Here's the thing most people get completely wrong about this topic. When we talk about investing at 18 versus 30, most people frame it as a race, like there are winners and losers. Like if you didn't start at 18, you already lost. And if you did start at 18, congratulations, you get to feel smug about it for the rest of your life. That framing is wrong. And honestly, it's a little cruel. Because the reality is, most 18-year-olds in America are not in a position to invest. And I mean that structurally, not personally. The median family income in the United States hasn't kept pace with the cost of actually being alive. Rent is higher relative to wages than it was for basically any generation before this one. Student loan debt is at a level that would have seemed insane to people in the 1980s. The average American in their early 20s is spending over 30% of their take-home pay just on housing. That's before food, before transportation, before the debt they took on just to get into the workforce. So if you're 25 right now and you haven't started investing, I need you to hear this clearly. That is not a character flaw. That is not proof that you're bad with money. That is the predictable result of a system that was not designed to make it easy for young people to build wealth. I'm not saying that to give you an excuse. I'm saying it because the shame spiral around money, the I should have started sooner, what's wrong with me loop, that spiral actually keeps people from starting. And starting, even late, is the only thing that actually matters. But here's where it gets interesting. There really is something mathematically and psychologically profound about starting early. Not because people who start at 18 are smarter or more disciplined, but because of something so simple, so quietly powerful, that most people don't really grasp it until they see it laid out in front of them in a way that makes it feel real. That thing is time, but not time the way you usually think about it. Let me start with two people. I'll call them Alex and Jordan. Alex grows up in a household where nobody really talks about money. College, decent job, the usual American story. At 30, Alex finally has some financial breathing room. Reads a few articles, watches a few videos, probably something like this, and decides it's time. Alex starts investing $500 a month at 30. Does that every month, doesn't stop, keeps it up until 65. That's 35 years of consistent investing. Jordan is a little different. Jordan's family wasn't wealthy either, but somewhere around 18. Maybe a grandparent said something, maybe a teacher, maybe Jordan just stumbled into the right rabbit hole. Jordan starts putting away $300 a month. Just $300, less than Alex will eventually invest. Jordan does that from 18 until 65. That's 47 years. Now, assuming both of them get an average annual return of around 7%, which is a conservative, historically reasonable estimate for a diversified stock market index fund, here's what happens. Alex, investing $500 a month for 35 years, ends up with roughly $900,000. That's not bad. That's actually really good. Alex is a millionaire. Jordan, investing only $300 a month for 47 years, ends up with somewhere around $1.37 million. Jordan invested less per month. Jordan invested less total money out of pocket, but Jordan ends up with almost $500,000 more. That gap, that $470,000 gap, isn't skill. It isn't luck. It's entirely, purely, 100% the result of those 12 extra years at the beginning. And this is what people mean when they talk about compound interest. But I want to explain it in a way that actually makes it click, because most people have heard the phrase, and it still doesn't feel real. Compound interest isn't just your money making money. It's your money making money, and then that money making money, and then that money making money. And this process does not grow in a straight line. It grows in a curve, slowly at first, almost imperceptibly. And then, after a certain number of years, it starts to accelerate in a way that genuinely looks like magic if you've never seen it before. Think of it this way. In the first few years of investing, say you put in $5,000 and your investment grows 7%. That's $350 in returns. That feels modest, underwhelming even. You're working hard, you're being responsible, and you made $350 extra dollars? Great. But by year 30, that same 7% isn't being applied to $5,000 anymore. It's being applied to $250,000, which means in a single year, that money generates $17,500 without you doing anything, without you working an extra hour, without you thinking about it. It's just sitting there, working for you, while you sleep, while you stress about work, while you watch your kid's soccer game on a Saturday. This is the part that genuinely shifts something in people's minds when they understand it at a gut level, rather than just a conceptual level. At the beginning, you are the engine. You are putting in the money. You are powering the machine. But over time, if you give it enough time, the machine starts powering itself. And eventually, the machine is doing more work than you are. The tragedy of starting at 30 instead of 18 isn't just about the final number. It's about when in your life that machine kicks in. If you start at 18, the machine is starting to really hum right around the time you're in your 40s and 50s, the decades where life tends to get the most expensive. Kids in college, parents needing help, health costs creeping up, career transitions, divorce sometimes. Life, basically. And if you started early, the machine is already working for you during all of that. If you start at 30, the machine is still warming up during those years. It'll get there, but you're doing more of the heavy lifting yourself for longer. Now, and this is important, none of this means your life is over if you're 30 and haven't started. At all. The numbers still work in your favor. The math still rewards you. But the flavor of that reward is different. And understanding that difference is what actually motivates people to do something about it today, rather than another someday. Let me tell you something that almost nobody talks about when they cover this topic. There's a psychological dimension to starting early that doesn't show up in any spreadsheet. When you start investing at 18 or 19 or 22, something shifts in how you relate to money. Not overnight, not dramatically, but gradually. You start to see your money as something that does things while you're not watching it. You start to see spending decisions differently. Not as deprivation, not as punishment, but as a trade-off between now you and future you. That's a genuinely different way of thinking about money. And it's a skill. It's a mental habit. And like most mental habits, it gets more natural the longer you practice it. People who have been investing since they were young often describe a shift that happens somewhere in their late 20s or early 30s. Their account balance starts to feel less like a number on a screen and more like a foundation. Like
something that's under them, even if they can't feel it in their day-to-day life. And that foundation does something powerful to your psychology. It makes you less desperate. It makes you less likely to make terrible financial decisions out of panic. It makes you more willing to take healthy career risks, like asking for a raise or leaving a job that's burning you out, because you're not operating from pure financial terror. Financial security isn't just about the number. It's about what the number does to your nervous system. And I want to be real about the other side of this too, because I think it's worth saying honestly. People who start investing at 30 or 35 often feel this background anxiety, this low hum of, I'm behind, I'm catching up, I have less time. And sometimes that anxiety actually makes people worse investors, not better. Because anxious investors tend to make reactive decisions. They check their accounts too often. They panic when markets drop. They chase trends. They get talked into things by people who smell desperation. The calm that comes from having started early, from having that foundation, actually makes you a better investor. It makes you more able to just leave things alone and let compound interest do its job, which is, honestly, most of what investing requires. Here's another angle on this that I don't think gets enough attention. There's a concept in behavioral economics called future self-continuity. It basically describes how connected you feel to the person you'll be in 20 or 30 years. And research from UCLA and Stanford has found that people with low future self-continuity, people who basically feel like their 60-year-old self is a stranger, make dramatically worse long-term financial decisions. They're more likely to spend impulsively, less likely to save, less likely to invest. And here's the haunting part. When you're 18, your future self is maximally abstract. You are the least connected to your 50-year-old self that you will ever be in your entire life. Which means 18 is, psychologically, actually the hardest time to make long-term financial decisions. Your brain is literally less equipped to care about someone so far away. So the fact that more people don't start at 18 isn't because they're lazy or irresponsible. It's partially because human psychology is designed for the immediate. We are wired to care about today, this week, this month. Caring about 40 years from now is genuinely unnatural. It requires effort. It requires some kind of belief that your future self is worth protecting. And that belief, that your future self is real, is worth it, is a person who will one day wake up and be grateful or resentful depending on what you did today, that belief is something you can actually cultivate. It's not fixed. It can grow. Here's the reframe I want to offer you, and I want you to sit with it for a second. Most people think of investing as something you do with money you have left over. Whatever's left after rent, groceries, car payment, subscriptions, going out, all of it. If there's anything left, maybe you put some in savings or investments. Money as a leftover. But the people who build real financial security, not just theoretical spreadsheet security, but genuine felt security, almost universally think about it differently. They decide on a number first. They treat that number like a bill. They automate it, and then they live on what's left. This isn't about deprivation. It's about sequence. It's about deciding that your future self has a seat at the table before you figure out how to spend the rest. The psychological power of automating this, of setting it up so the money moves before you can even see it in your checking account, is enormous. Because our willpower around money is genuinely limited. Decision fatigue is real. By the time you've gotten through a full day of work, made 100 small decisions, dealt with whatever stress came your way, the version of you who sits down at night to manually transfer money into investments is a depleted, tired, slightly stressed version of you. And that version of you will often say, just this once, let me skip it.
But if the money moves automatically, there's no decision to make. There's nothing to skip. Future you is protected by past you's setup, not by present you's willpower. That's not a hack. That's not a trick. That's just understanding how human psychology actually works and designing around it. The other mindset shift I want to point to is this. Stop thinking of the stock market as something that happens to you. Start thinking of it as something you own a piece of. When you invest in a broad index fund, something like a total U.S. stock market fund or an S&P 500 fund, you are literally buying small pieces of hundreds of the biggest, most productive companies in America. When Amazon earns a profit, you get a tiny slice. When Apple sells another iPhone, you get a tiny slice. When every company in that index collectively grows, your investment grows with it. You're not gambling. You're not speculating. You're becoming, in the most literal sense, a partial owner of the American economy. And if you believe that America will broadly produce more value in 30 years than it does today, which over any long historical period has reliably been true, then owning a piece of that production is one of the most rational things you can do. That framing matters because it changes how you feel when the market drops 20% in a bad year. Instead of feeling like you're losing a bet, you feel like things are on sale. Instead of panic selling, you stay put. Or if you're really paying attention, you buy more. Let me talk about what this actually looks like in real life, because abstract concepts only do so much. If you're 18 to 22 right now, and you have any income at all, even if it's small, the single most important thing you can do is open a Roth IRA. I want to be clear, I'm not giving you financial advice, but I can tell you what a Roth IRA is and why people your age love it. A Roth IRA is a retirement account where you put in money that's already been taxed. And then here's the beautiful part. It grows tax-free. Completely. When you retire and pull that money out, you don't owe taxes on any of the growth. Which means if you put in $10,000 when you're 20 and it grows to $120,000 by the time you're 60, the IRS doesn't get a cent of that $110,000 in growth. For someone young, in a lower tax bracket, with decades ahead of them, the Roth IRA is one of the best financial tools available to regular people in America. The contribution limit in 2024 is $7,000 per year, which works out to about $583 a month. You don't have to hit the limit. You can start with $50 a month. You can start with $25. The point is to start. If you're in your mid-20s to early 30s and you have a job with a 401k that includes an employer match, please do not leave that match on the table. An employer match is the closest thing to free money that most of us will ever encounter. If your employer matches 50 cents for every dollar you contribute, up to 6% of your salary, and you're not contributing at least 6%, you are literally declining part of your compensation. That's money they are willing to give you that you are choosing not to take. For those of you who are in your 30s and feeling genuinely behind, I want to say this gently but clearly. You are not starting over. You are starting now. And those are very different things. The math still favors you. If you're 32 and you start putting away $600 a month with a 7% average return, you'll have around $750,000 by 65. That's not as much as the person who started at 18, but it is a profoundly different retirement than the person who never started. And $750,000, if managed thoughtfully, can produce around $30,000 a year indefinitely, using something called the 4% withdrawal rule, meaning you never have to touch the principal. That's $30,000 a year in passive income on top of whatever Social Security looks like by then. Is it enough to retire in luxury? Depends on your lifestyle. But is it enough to not be financially desperate in your 60s? Absolutely. There's also a concept worth knowing called catch-up contributions.
Once you hit 50, the IRS actually lets you contribute more to retirement accounts than younger people can. It's a recognition built into the tax code that not everyone had the runway to start early. It's not a perfect fix, but it's something. Now, for anyone watching this who has student loans or credit card debt and is wondering whether to invest at all while carrying that debt, here's a simple framework that a lot of people find useful. High interest debt, typically anything over 7 or 8% interest rate, which most credit cards are, should generally be prioritized over investing. Because if you're paying 22% interest on a credit card balance, you would need to consistently beat 22% returns in the market to make investing the better choice. That's extremely unlikely. Pay down the high interest debt first. Lower interest debt, things like federal student loans in the 4 to 6% range, is a tougher call, and reasonable people disagree. But many financial thinkers suggest at least investing enough to capture your employer's 401k match while you're paying down moderate interest debt, because the match itself often offsets a significant portion of the interest cost. The main thing I want you to take away from this section is that this doesn't have to be complicated. You don't need to be an expert. You don't need to pick individual stocks. You don't need to watch financial news every day. Honestly, watching financial news every day is probably bad for your investing outcomes because it creates noise that makes you want to do things when doing nothing is usually the right move. Start with an index fund that tracks the US stock market, or a target date retirement fund, which automatically shifts its risk level as you get older. Set it to automatic, increase the contribution when your income increases, leave it alone. That's it. That's genuinely most of it. I want to end with something that I think is the most underrated idea in all of personal finance. You are not behind. You are exactly where your specific circumstances have put you. And where you go from here is the only thing you actually control. There's a version of this conversation that's designed to make you feel guilty, to weaponize your regret, to show you the gap between where you are and where you could have been if you'd just done everything perfectly at 18. And I hope this wasn't that conversation, because that conversation is cruel and it doesn't help anyone. The version I wanted to have with you is the honest one. The one where we acknowledge that compound interest is real, that time matters, that starting earlier is genuinely better, and also that most people don't start early for reasons that are understandable and human, and sometimes completely out of their control. Money is not a morality test. Your net worth is not your worth. And the person who starts investing at 30 or 35 or 40 and does it consistently, thoughtfully, without panic, will live a fundamentally different life than the person who never starts. That's the only comparison that matters. I think about the quiet kind of freedom that comes from having money that works for you. Not freedom in a champagne on a yacht way, just the everyday kind. The freedom to say no to a job that's slowly crushing you. The freedom to help someone you love without going into debt to do it. The freedom to not lie awake at 3 a.m. doing math in your head about whether you'll be okay. That freedom starts with a decision. A small one that can feel silly or premature or like it doesn't matter yet. It does matter. It always mattered. And the fact that you're watching this, thinking about this, asking these questions, that already means something. Start where you are. Use what you have. Do what you can. And let time do the rest. If this video helped you think about money even slightly differently, share it with someone who needs to hear it. And if you want to go deeper on any of this, the Roth IRA, index funds, how to actually set this up, let me know in the comments, and I'll make that video next. See you in the next one.